The most frustrating thing people don't understand about pensions is how return and risk works, okay? And that you're actually trying to maximize your returns for the risk. Now, save this because I'm going to give you some data which you'll want to come back to later. A portfolio which generates historically 36% per annum but has a volatility of 18%. What the hell does that mean? And were it to repeat that in the next 5 years, what would that mean? Were it to? It's not guaranteed to. Okay. Well, in one sense, this is what it means, and you can do this, and we do this for clients. Annual return probabilities. What's the chances you're going to get more than 12.5% per annum? By the way, 15% per annum over 5 years means you're doubling your money. Well, there's a 95% probability that you will get more than 12.5% per annum return. So roughly 95% probability you're going to double your money in 5 years. Okay, you might be able to do it in 3. Okay, if the returns are even better. The reason this kind of understanding is important, and people understand that things in the future are not certain nor guaranteed, but there's a range of probabilities based upon how certain things have moved in the past. Think of it like this: Apple or Microsoft or whatever, Costco, Walmart, Intel, Novo Nordisk, they're all good companies with a certain track record. Now, if for 1 second we make a massive assumption that they continue to do into the future what they've done historically. In other words, a coin is 50-50. A coin might go 50-50 into the future. This is another way of saying, if you toss a coin 100 times, 50 times you'll get heads, 50 times you get tails. The one thing I'll guarantee, if you toss it 100 times, you will not get 50 heads and 50 tails. There'll be a range of probabilities each time you do that exercise. Feel free to do it. There's actually probably websites on the internet which will do 100 hypothetical coin tosses for you and show you the variance. Okay. In that same way, we're trying to find coins in the form of companies which not 50% heads, 50% tails, but have a positive skew to the upside. And by giving a long enough time, i.e. long enough coin tosses, we're trying to get closer to their longer term average, making a very big assumption that the coin is suddenly not going to become defunct halfway through after, say, the 10th toss, and it's just going to throw up tails all the time, or Apple is not about to become defunct. So in that sense, Warren Buffett's job, my job, is to try and find companies and coins which continue doing what they're supposed to do and have done previously. Our job is not to keep jumping horses in the middle of a race. Anyway, I hope that helps you and makes some sense for how pensions work and how they should work in terms of returns. You can also apply the same for loss probabilities for a set of securities. And what you're then asking is, what's the chances, Alpesh, that I'll have a loss over a defined period of, say, more than, I don't know, to my pension, more than 15%? Well, there's a 15% chance. What about by the end of the period? Now, why is that important? Why is it important to know within the period and at the end of the period? Because actually, in a way, within the period is just making sure you don't have a panic attack because you're not selling at that point. End of the period is important because that's the point you are forced to sell, okay, whatever that end period might be. And that's why we do it both ways, just to manage people's expectations. Because guess what happens when you manage people's expectations with regards to returns? They don't panic and they don't get bored. If they don't panic and don't get bored, they hold to the end. If they hold to the end, they get what they were told. The problem with IFAs and wealth managers, including at places like St. James's Place, is they end up delivering really piss poor returns. They don't even get close to anything like this. What they end up with is saying, well, we'll give you 5% per annum, because there's a whole bunch of funds that they get paid a lot of money to try and sell you. That's the basic problem. Anyway, if you'd like a free copy of my book, you'd like to speak to us, you'd like more resources, courses, anything else for free, have a look at the links in the bio. It's all in there. Thank you very much.